No audio.
Before we begin, please take a moment to review the disclosures. We'll start momentarily. Hey everyone, welcome back. So today I want to walk you through a company that's been quietly building something pretty interesting in the semiconductor equipment space. The company is ACM Research, ticker ACMR, and it trades on NASDAQ. Now, before we get into it, I want to be upfront. This is purely a research deep dive. I'm not telling anyone to buy or sell anything. I'm just sharing what I found during my research, and you can take it from there and do your own homework. Cool? All right, let's get into it. So ACM Research, what do they actually do? The company was founded back in 1998 by Dr. David Wang out of Fremont, California, and at its core, ACM designs and manufactures semiconductor process equipment. Think of the machines that chip fabs use to clean, plate, and prepare silicon wafers during manufacturing. Now here's where it gets interesting. They just hit $901 million in revenue for 2025, which is a 15% jump year over year. And they're guiding for over $1 billion in 2026, somewhere in the $1.08 to $1.18 billion range. For a company most people haven't heard of, those are pretty serious numbers. They're also sitting on $845 million in net cash, which, for a company this size, that's a fortress of a balance sheet. And management has thrown out this long-term target of $4 billion in revenue. That's ambitious, but we'll talk about whether that's realistic in a minute. Now, what really caught my attention is what they just did with their product lineup. In April 2026, they reorganized everything into what they're calling the ACM Planetary Family. 8 product families, each named after a planet. You've got Earth for cleaning, Venus for electroplating, Mars for furnace systems, Jupiter for wafer level packaging, and so on. It's a clever way to signal that this isn't a one-product shop anymore. They've expanded from just cleaning tools to a full platform of semiconductor equipment. And they're also opening a facility in Oregon, set to go live in the second half of 2026, which is a big deal for their US expansion story. Let's talk about the technology that makes all of this work. All right, so this is a slide that really made me sit up and pay attention. ACM's core competitive advantage comes from 2 proprietary technologies, SAPS and TIBO. SAPS stands for Space Alternated Phase Shift, is their patented megasonic cleaning technology. And what it does is remove tiny defects from really intricate 3D chip structures, like the kind you see in advanced 3D NAND memory, without damaging the features. If you know anything about how delicate these structures are at the nanometer scale, that's no small feat. Then there's TIBO, Timely Energized Bubble Oscillation. This one is more of a process know-how asset, and honestly, it might be even more defensible than SAPS long-term. Because once a customer goes through the qualification cycle, which can take 12 to 18 months, they're basically locked in. Fabs do not like switching equipment vendors mid-production. It's too risky, too expensive. And then there's Tahoe, their newer cleaning platform that's gaining traction with leading foundries. So they're not just relying on legacy tech, they're continuing to innovate. But here's the moat that I think a lot of people miss. The geopolitical angle. US sanctions on companies like Lam Research and Screen Holdings have effectively limited foreign competition inside China. And since ACM has its operations structured in a way that lets them serve the Chinese market, they've ended up with something close to a near monopoly position in China's wet cleaning equipment space. On top of that, their tools are priced 20 to 30% cheaper than Western competitors. That combination of limited competition and lower pricing, that's a tough moat to crack. Now, let's look at where the growth is heading. Okay, so looking at this revenue chart, you can see the trajectory. They went from $365 million in 2022 to $901 million in 2025. That's roughly a 2.5x in 3 years, which is a solid growth rate for a capital equipment company. Analysts are projecting somewhere around $1.7 billion by 2029, and management has this aspirational $4 billion long-term target. Now, what's driving this? A few things. First, AI and high-performance computing are creating massive demand for advanced packaging. Every time you hear about a new AI chip, those chips need to be packaged using increasingly complex processes, and ACM has tools for that. Second, 3D NAND flash memory keeps adding more layers. Every new layer means more cleaning steps during manufacturing. More cleaning steps means more cleaning tools. It's like a built-in demand multiplier for ACM's core business. Third, and this is the one I find most exciting, Intel. Reports came out that Intel has been testing ACM's wet etch tools at their Hillsboro facility for their most advanced 14A process node. If Intel qualifies these tools for production, that could be a game changer for ACM's US revenue. Right now, the vast majority of their revenue comes from China, so cracking a major US customer would completely reshape the narrative. And the timeline here shows you the progression. Record revenue in 2025, Oregon facility going live in 2026 for domestic production, and potential Intel production qualification in the 2027 to 2028 window. But look, it's not all sunshine. Let's talk about the risks. So on the left, you got the strengths. Dominant position in China, proprietary tech that's hard to replicate, a cash-rich balance sheet with $845 million in the bank, 8 product families making them a platform company, and the AI and 3D NAND tailwinds expanding their total addressable market. Plus, those tools being 20 to 30% cheaper gives them a real edge on pricing. But on the right, and you have to be honest about these, the risks are real. The biggest one is China concentration. Over 85% of their revenue comes from China. That's not necessarily a problem today, but it means any tightening of US export controls could hit them hard. And we've already seen their Shanghai and Korea subsidiaries get added to the entity list in late 2024, which creates uncertainty. Gross margins took a hit in Q4 2025, dropped to 41%, below their target range. Some of that was product mix, but it's something to watch. Their SAPS patents start expiring toward the end of the decade. And there's a Chinese competitor called Kingsemi that's narrowing the technology gap, especially after Nora invested about $1.7 billion to back them. And the CEO has been selling shares around $4 million worth in recent months. Now, insider selling doesn't always mean something bad. People have bills, taxes, diversification, but it's a data point you want to be aware of. So that's the balanced view. Now let's wrap up with the forward outlook and something that makes this story even more interesting, the acquisition angle. This is where it gets really interesting for me. ACM Research checks a lot of boxes as a potential acquisition target. Think about it. They've got proprietary wet cleaning IP that's already qualified in major fabs. They have deep customer relationships with some of the biggest names in the industry. SMIC, SK Hynix, YMTC. They've expanded from 1 product line to 8. And they have strategic access to the Chinese WFE market at a time when most Western competitors can't operate there. So who might be interested? Applied Materials could use ACM to fill their wet cleaning gap and gain China market access. Tokyo Electron could expand their cleaning portfolio. Lam Research could add complementary wet etch tools. And then there's Nora Technology on the Chinese side, who's already making moves to consolidate the domestic market. They invested heavily in Kingsemi, so they clearly see the value in this space. Now, would an acquisition actually happen? That's hard to say. The geopolitical dynamics make any cross-border deal complicated, and Dr. Wang owns over 57% of voting shares, so he has control. But the point is, the strategic value is there, and that creates a floor of sorts for the company's valuation. Looking at the forward outlook, analysts are projecting fair value somewhere in the $65 to $82 range over the next 3 to 5 years. That's based on revenue growing toward $1.7 billion by 2029, with a long-term vision of $4 billion. So to wrap it up, ACM Research is one of those companies that sits at this unique intersection of proprietary technology, geopolitical positioning, and structural growth in AI and semiconductor manufacturing. It's not without risk. The China concentration and entity list issues are real. But the setup is fascinating from a research perspective. That's it for today. If you found this helpful, drop a like, subscribe, and I'll catch you in the next one. As always, do your own due diligence. See you next time.